Alec, whenever you're ready.
Yeah, it's good.
Okay, well, hello everyone and welcome to our webinar, Why Multifamily Investing. I'm Alec Randall, Director of Client Relations. It's my pleasure to be moderating tonight's discussion. I think it'll be a great overview of the different types of properties investors can look at in the multifamily space. We would just ask that you mute yourself if you're not talking, and feel free to put any questions into the chat. So with that, I'll hand it over to Edward and Ravi to introduce themselves.
Hey guys, I'm Edward Sarkeesian, CEO of Yankee Capital. It's a pleasure to be here, and hope you enjoy our little webinar here tonight. Wanted to guys give you a quick background on who I am and what I've done in the past in real estate, so it'll help with today's discussion. Essentially, Ravi and I met back at Babson College about 16, 18, almost 18 or so years ago. During that time, I started a construction company in college focusing on multifamily, specifically apartment complex renovations. I've done this work regionally through college, and after I graduated, working with many of the area property management companies as well as commercial property owners. And during that time, essentially our company specialized in renovation work, capital programs, and asset optimization. When Ravi founded the company, I was always intrigued, and at one point he asked me to join, and the rest sort of been history.
Thanks, Ed. So my background, my name is Ravi Dave. I'm the CEO of Yankee Capital Partners. My background actually stems from first the brokerage side and then the finance side. I also have my master's in real estate development and construction management. And I got my interest in multifamily, which we'll be talking about today, during my time in private equity. So when I was in private equity, we were lending anywhere between $5 to $50 million across all different asset types. So that means hotels, hospitals, office, industrial, retail, and multifamily. And so at that time, I said, okay, multifamily seems like the way to go. So roughly about 3.5 years ago, I was able to start Yankee Capital and begin the kind of the process to start looking at properties. I had different visions of which route I was going to take. And I finally kind of found my niche, which we'll be talking a little bit later on today. And I underwrote financial underwriting, countless deals, over 100 different deals, and finally secured a property roughly just over 2 years ago in Texas. And it's been performing ever since. Brought on Eddie just about 2.5 years ago. And it's been invaluable to have him on the team and be a good partner for me.
Fantastic. Well, thanks, guys. We got a lot to cover tonight. So we'll be walking you through what a multifamily property actually is, the different types of properties within multifamily, what an investor can expect by way of benefits from investing in a property like this. And then finally, we'll run through some key elements of what we look for in a potential investment. So Ravi, if you want to take it away, we can get going.
Sure. So from the high level approach, multifamily is the basic definitions, 2 to 5 units and above. There's different unit types from small, 2 to 5 to medium, 50 plus to what we do, 100 plus, or even far more. You can actually, multifamily has different attributes, location, the amenities, different incomes from the tenants themselves, income from the property, other incomes from the property. Too many to kind of ramble on right now, but ultimately it's broken down into different classes. And so we're going to talk about a few different classes today to kind of give you a brief overview of what multifamily is all about.
Yeah, to piggyback off what Ravi said, within multifamily, there are multiple classes. You have your class A, which is on one side of the spectrum. That's a typically new construction, high end, lots of amenities. On the other side of the spectrum, you have your class C, which are the older properties located in less desirable neighborhoods with lower income tenants. We find our sweet spot is essentially Class B, and the reason we like Class B space is there is a lot of room for upgrades that can drive appreciation of the property. Class B generally is your property type where it requires light to modest renovations. It's built after 1978. We like the garden style communities, 2 stories with a clubhouse and a pool. And the reason for that, it's really it's easier to operate those in terms of maintenance and operations wise, as well as implement our strategy in the value add, which we'll discuss a little bit later on. But also Class B has the biggest tenant pool of potential renters, and it's more resilient through economic booms and busts that we've seen in previous cycles, and
We saw it in COVID this year,
and even now it has proven to be resilient, which we'll get into a little bit later on in the presentation.
Great stuff. Okay, so one question here to start us off is, say I'm investing in a multifamily property, what kind of benefits can I expect?
So I think first and foremost, it's the principal protection. You're seeing it be a resilient, tangible asset. We've seen this past year where how multifamilies performed in light of the pandemic. The diversification is huge. We've seen historically that anybody that has real estate, especially multifamily, as a part of their portfolio, their risk goes down and their income goes up across their portfolio. The passive income stream is quite big. People that know this space, know multifamily, know that to build wealth, passive income is really important. And the third, and probably the most important, is the tax benefits. What we've seen with the past couple of administrations with depreciation, that we really are able to take depreciation and use it for our benefit. A couple of administrations ago, they introduced accelerated depreciation that has really helped investors because you're able to depreciate the entire asset minus the land and weigh that against the income of the cash flow from the property. So therefore, it creates a paper loss for the investor, and ultimately they're sitting on tax-free income, and that's a huge benefit. The other thing is you can invest into multifamily if it's a syndication or if it's a deal through self-directed IRAs. That's pretty important. And ultimately in multifamily, depending on what type of multifamily you pick, the ultimate goal, not only with passive income, is to increase that income of the property to drive the value up. And as we'll see later on, that can prove invaluable.
Yeah, and one of the things that we see a lot of is for investors that are greatly exposed in the stock market is diversification aspect, right? We talk about that all the time, how owning real estate, one is a hedge against inflation, but also it allows you to diversify away from, the stock market where you want to have an asset class that doesn't correlate to what's going on. And as we've done a lot of research and studies in terms of multifamily and how it compares within core commercial real estate in general or against other asset classes, it's really one of the most stable asset classes past the treasury. So lots of insurance companies, bank are owners of apartment complexes.
30% for insurances. Yeah.
Wow. Yeah. So that really speaks to the story that this asset class really stands the test of time in terms of ups and downs. So for somebody that's looking to diversify into an asset class, real estate provides that exposure. And there are multi-different benefits that Ravi, just briefly touch base on that we can get into,
on
other presentations as well.
Well, absolutely. One thing that we talked about was the accelerated appreciation of the property. So organically, you're going to get rent growth, and we're going to be collecting rents on a property, and you can actually just organically increase the rent each year. But if you're buying a value add, as we call it, multifamily, we can go in and rehab that unit, increase the rents 15, 20 or more percent. And instantly that helps the bottom line and it drives everything up. And I would say the other thing would be economies of scale.
Yeah, no. So going back to what we discussed in the beginning, our focus has always been 100+ type units. So in that type of property, we're able to utilize our buying power, and that's where economies of scale comes in, where we're negotiating with contractors, vendors. We have a gentleman here on the call. His name is Ray, who we work with on our team that helps us do that. And drive our costs down, overall, so that essentially we're able to perform projects faster and cheaper and provide that benefit to our investors. But in essence, having a larger property doesn't mean it's a lot harder work. It's actually in essence work that can be done with the right team, but you're able to have the benefit of getting cheaper costs with your suppliers and your contractors from the team.
Exactly.
We have a quick case study of what we've done on our current investment in McKinney, Texas, that we acquired 2.5 years ago. When we underwrote the property, we were planning to renovate the units at the property to raise the rents. A typical unit when we bought it is on your left, which is your classic unit, we call it, with a closed-in kitchen as well as wooden style cabinets and Formica countertop with carpet in the living room. And what we've done is we spent countless hours of research in what the market is essentially providing in terms of the apartments in the area and what they're charging for rent, in order to figure out what our mix of offering would be in our unit. So we've decided to open up the kitchen, install planks, install quartz countertops, as well as black appliances and tile. And we added a few little items. We were going back and forth in terms of usability, like USB ports go a long way. We've also added a mantle over the fireplace and some outlets for people to be able to hang their TV and be able to use the apartment much better than the previous management was able to do it. These specific investments that we are making, will get us the returns that we're looking for, because we've done the research and also have set up our vendors and contractors that can execute those things for us at a much faster clip, and also below market rents, because we have 100+ type property.
And it really pays off with that income, as we talked about earlier. It's the exponential potential as you grow income up, even at the even smallest amount. I mean, if we're getting 15-20% rent bumps on a unit, and you're spreading that across many different units, that increase in the income really increases the value.
Yeah, and case in point here on the exteriors as well. So that some of the things that we do might not affect the bottom line, right away, but it also creates the atmosphere for our residents. When we acquired the property, for example, not a lot of people were using outdoor space because they had the dirt paths. So we decided to use recyclable asphalt as a way to provide nice pathways for the tenants to walk around from building to building. We also decided to renovate the balconies, and while we were looking at that, you might not be able to see it in the picture, but there's a little backyard at the bottom right that we've added to a few of the properties out there, a few of the units out there, which essentially for a $600 to $700 investment resulted into an additional $75 increase per month. This was actually a decision we made before COVID times. It was for an outdoor space for somebody that wanted to hang out outdoor during the day, or even had a small pet. But as there's been a huge increase in demand because of COVID, for that type of space. So it'll help our property to perform better. And overall, the reason we like the garden style 2-story suburban apartments, even before COVID-19, was that it allowed a spacious area to implement all of our construction type work, but also allowed to keep the community and feel of the type of property where a lot of the residents wanted to stay and are staying, as we have, developed the program.
Our resident retention, July, August of last year was at 70%. The previous year was 35%. That meaning that as people's leases come up, only 35% were renewing, and July, August the following year, 70%. I mean, it goes to show you that if you can make the right touches and increase the curb appeal, the community aspect, you're going to keep good long-term residents. So here's a good chart, essentially focusing on multifamily on a larger scale, 100 plus units, and multifamily on a smaller scale, and the different risks associated with that. I'll start with occupancy risk. Basically,
we have a great example that we always talk about, and that resonates with me as I've owned multifamily properties before, and I know a lot of people that do as well. But for a two-family, if for example somebody vacates a two-family unit, that's a 50% vacancy loss. On a 100-unit plus complex, if one tenant vacates, that's only a 1% loss. So even though in the grand scheme of things you have a lot more units, you actually are much safer in terms of occupancy risk overall versus having multiple units that are functioning as 2 units at a time to be able to get the renters there. And that goes back to your mortgage risk as well, that the financial aspect of it, right? When we underwrite the property,
that we have a break-even occupancy on the property. If we fall below a certain occupancy, that's going to hurt all our expenses, all our debt payments that we have to make for the property. And that risk just goes way up when you have a smaller amount of units. And so, those two coupled with the economy of scale that you brought up, Eddie, before, property management fees on a smaller scale, 6 to 10% or higher sometimes. On our level, I know on our property, it's 2.5%. And we have an incentivized program that, if they can overperform on our budget that we set forth, that goes up to 3%. And so I think it's really vitally important to kind of just differentiate the two. The other thing is the tax benefits we talked about earlier. Tax benefits at the larger level is greater. You can really maximize on an apartment complex versus maybe in a couple of units. And ultimately, this all adds up to a better return on your investment.
Yeah, and to top it off, I think it also comes down to the time you spent. We always have investors come that own and operated, a couple of 2 families, a couple of 3 families, and they're just tired of being the construction manager, being the property manager, being the maintenance supervisor. So they're looking to either sell off or they already sold off and looking to invest into a larger type of syndication. Where they can enjoy all the benefits of real estate exposure, but not necessarily have the headaches of the day-to-day management. For us, myself, Ravi, and Alec, we're here at 8 o'clock at night talking to you guys. It's certainly not a headache. We don't even consider this work. So we're definitely are excited and enjoy what we do. So. Having people like ourselves on a team that can essentially expose investors to real estate, especially on the larger scale, which we discussed with the benefits of economies of scales and the entire asset class, would be a great benefit to an individual investor that had properties that managed themselves, or was either deciding to go in and buy a property and manage it themselves, or just put it away and be able to do it like that.
So we have here we call it a cheat sheet, as you would say. The point of this presentation was to get everybody a really good understanding, high level of what multifamily is all about, the different attributes, maybe what we look at as well. And as you can see here, we have location, property, measuring the potential of what you can get from the property.
And we get asked a lot, why Texas, why North Carolina, why Georgia, and how do we go through the process of identifying the property? So we wanted to get this on board for you guys, and we'll distribute this after the presentation today in terms of, how data-driven we are in order to find the right investment that will perform in the downturn market as well as, in an upward moving market. So, just going in briefly in terms of location, we would look at crime. We want to make sure that the area has low crime. School is a big area for us, that we want to make sure that the school system is, top school district is, in that area.
Especially if you have young families, elementary schools are really important to have nearby.
And income, with the B grade value add strategy that we utilize, we are able to, drive the rental growth and want to make sure that the income levels in that area are able to absorb that over time as we make those improvements to the particular property as well.
I mean, if you're focused on cash flow and not appreciation, then maybe it doesn't matter as much. But if you are focused on cash flow and appreciation, that income is really important, because that median income, 40% of people's incomes go towards rent. And if you have a low income that's going to be kind of sitting there not doing much, you're going to be getting the same kind of rent for a while. And if you have that median, above median, or if that area is actually increasing their incomes, therefore you can organically grow that rent. And then when we just talked about renovating those units and making sure that the property can actually absorb those 15-20% rent bumps, that income is pretty important.
Yeah, absolutely. We spent a lot of time on really figuring out that sub-market area where the property is located to make sure that we'll succeed. And we feel we've done a good job with selecting our first property at McKinney, Texas, that during COVID has really done much better than the national average, right, in terms of vacancies and rent collections. And when we finish looking at the neighborhoods, then we look at the property itself. We look at the age of the property, we look at the size, we want the unit mix, and all those things will help us determine how that property is going to perform in a particular market. And that really helps us find the right neighborhood and the right property on 100+ type of unit, but it also can help anybody that is looking for a smaller investment with by themselves. So if you were to go in and look for a 2 or 3 family that you want to self-manage, you could go through these points as well to understand, is this property going to perform well in a certain market that I'm looking at. So, we wanted to share that information with you.
And the good thing these days, I mean, we had to do this during COVID. Google Maps is really big. I mean, we were able to, look at certain deals in each of the states where we wanted to do a 5, 3, and 1 mile radius on location. We wanted to scout out and see, okay, is there a pawn shop over here? Is there a checks cash? Okay, I want to avoid that area. And those things, they help. I mean, I think using technology for your benefit, that also helps. We're really data-driven geeks, and we look at data all day long, and that's really important. So I hope this can help. Really feel that it's a segue for getting started in multifamily.
That was great stuff, guys. Thanks very much. So one question here to get us going. You briefly touched on it, but how has COVID in general affected multifamily properties?
I think we all have been affected, personally, and for us, in our business, other businesses have been hit with it. I think even harder, especially with restaurants and hospitality. For us, multifamily has been a somewhat stable asset class to go through this pandemic. Of course, working with our residents on a day-to-day basis and making sure that the families that are in need are getting all the help they can get, whether it's from our property management company or other avenues that are available for tenants, has been the foremost importance for us, and they are able to help and go through this tough times. But in general, multifamily has fared well. Our property in particular, because of how much time we spend and the data that we collect on the neighborhoods and the property before we make the investment, it has fared well, much better than the national average.
I mean, I think also, the residents, I mean, I think when COVID hit back, basically 1 year ago, that those first couple of months, we did see people get affected by COVID. And there were payment plans that we had to put people on. As you mentioned, the property management staff has been invaluable. They provided all the, the resources through different, local assistance, rental assistance programs. All of that has helped. I mean, I think what it made us feel a closer connection to the community as well. And it's really hit home to us. And we feel it's good what we're doing for the community. Yes, it's a business at the end of the day, but we feel good about what we own, which is a good feeling.
That's great. Well, again, we encourage anyone to put any questions into the chat, or at this time, feel free to unmute yourself and just let us know if you have any thoughts or questions.
Question from Ray. He's saying, what do you look for in picking the right management company? Can you repeat the question? So
I think we have a question from someone. What do you look for when you're picking a property management company?
Yeah, it's a great question. For us, we are looking for a property manager that is experienced in the value add strategy. I think is one of the main sort of characteristics when we look at a property manager. They preferably are experienced in that area. They have a large enough team. They also have enough support. What we've seen in some of the other property managers that we've interviewed and we worked in the past, they overload some of their regional managers with too many properties, and you're not getting essentially the time that you need to really dive into the financials. So the property management company needs to be able to not only execute and work with us on our business plan, but also engage with the residents and engage with the community. And this is why the property manager that we have now was able to really work with the residents and hence the retention rate that we have at Ashton Oaks.
Yeah, and I think at the end of the day, that's probably 75%. The other aspect is that their fees too. You want to make sure their fees are aligned. As I think I mentioned before, we're at 2.5%, and then so what we do is we set a budget for the whole year, and if the property manager is actually able to exceed that budget, they get a little bump to 3%. And so their interests are aligned as much as we are. It used to be that you pick a property manager that maybe doesn't own a property, because that could be a conflict of interest. Let's say they own a property across the street. Whose property are they going to be taking care of? That could be a conflict of interest. What we've seen with our current property manager is that they do own a little bit, but they don't own near us, and they don't plan to own near us. So that's a good thing. And it's really been beneficial. It's been a win-win. So, yeah. Do you have some more questions?
See what we have coming through here.
Yeah, that property management.
Yeah. So what is the benefit of working with a sponsor in investing in multifamily?
Yeah, I mean, so essentially the sponsor, their risk is they're actually securing the debt for you. The debt that we get, let's say if we're buying a $10 million property, and you're taking out a 70% loan. So that's 70% loan, that's a $7 million loan. And typically most people don't have that exposure, or they're not able to secure that debt to purchase something like that. So what we do is, we pull the investors together, we take on that risk of securing that debt, which, we can, and essentially we manage that asset for you. We manage it, we do all the financial reporting. We manage all the construction projects. That's called asset management. And our goals are aligned. So you obviously take fees from that, but your interests are aligned in the sense that by the end, we're trying to hit a goal. We're trying to be above 14, 15% or higher total return per year on the investment. And so that sponsor is there working on behalf of you so you don't have to. And ultimately they're out there finding those deals that maybe you can't find individually. They have that expertise in doing so.
Yeah, and to add to that, I think it's the experience that we essentially use between all of us here on the team, as well as our vendors and partners that we bring to the table. For somebody that might not have those type of networks and might not even have the time. I mean, we spend countless and countless hours of just working in this business, so we bring that effort to every investment that we make. So anybody that invests with us are understanding of that. We spend tons of time on finding the right property, finding the right neighborhood, and making the right investment, so that they can spend more of their time with their families and enjoy their time off. Because if you were to do everything and invest into 2, 3, 4, 5 family units, you could run out of that time that you could have otherwise by investing side by side with us. But we also have the operational expertise to be able to run and perform on multiple of these type of business plans and investments.
I mean, and we also put our money where our mouth is. We actually invest into the deal itself alongside you as the same limited partner, or as part of the deal with you, you could say. And that's interests are aligned. So I mean, that's maybe one thing that differentiates us as a sponsor, maybe from other sponsors. But essentially, the bottom line is that when you're going with a sponsor that's syndicating a deal, you can use what we discussed earlier, those economy of scale, and go after 15, 20, $30 million project, whereas you wouldn't be able to do that by yourself. And ultimately, that means better return on your investment, and ultimately you can enjoy all the benefits that we've kind of laid out today.
Okay, that's great. That was the final question. So I just want to say thanks everyone for joining. If you have any other questions that come up, please be in touch, or the team will stay on for the next couple minutes if you want to unmute and ask a question right now. And also just that we'll be sending our slide deck around to everyone who attended for further reference, as well as a recording available of this. I just want you to keep an eye out for future webinars as we continue our series. So have a great evening, and the team will be here for the next couple minutes.
There is another question.
Sure.
How do we take the next step in investing in a property with Yankee Capital? And what is the minimum investment for a 100+ unit property?
Sure. So, I mean, next steps, I would say the first step is probably set up a call with one of us. The more direct method, if you will, is to go to our website, www.yankee-capital.com, where you can actually, we have a fund, we just launched a fund a couple of weeks ago, and that's able to, you're able to log in, download our investor deck, log in to the investor portal. You can walk through the we call it PPM, which is basically the deal that we're doing, and you can invest through the portal. But before you do that, I would suggest setting up a call with one of us to kind of review your financial needs, and we can address that. I mean, we're here to help.
Yeah, and to add to that, the current fund that we are raising, we do have a minimum requirement of $75,000. That was one of the other questions that came. Yeah. But absolutely, as Ravi mentioned, we do want to get to know you and your financial goals before you get a chance to participate with us and make sure this is the right fit for you.
Yeah.
Awesome.
Thank you very much, guys.
Thanks, guys.
It's been a pleasure. I hope you'll join us on others that we'll be coming up with in the near future, and hope you enjoyed this one.
And please feel free to reach out. yeah, we're always here to help, and hope you enjoyed it.